Welcome back, investors. In this video I'll introduce you to the various methods of company evaluation. Before moving forward, if you like this channel, obviously do not forget to like the video and also hit the subscribe button so that you get also the latest updates. And as always, reminding you that this content is for information and education purposes, and it's not an offer or solicitation to buy any kind or to invest into the stock market or buy any of the companies that I'm sharing with you here, but the intention is really to share my experience as an investor. So today in this video we'll be discussing and I will be introducing you to the company valuation methods, which is a tool that is hugely used by a lot of investors and analysts to try to figure out if the market is giving you an undervaluation or overvaluation of the company, but also it's a method that is being used in the private equity space and the venture capital space. And when we speak about valuation, obviously there is one person that comes directly to my mind, which is Damodaran, who's a professor of finance, and he's really considered a valuation guru. So he's working at the New York University Stern School of Business. And I like the sentence that he once nailed down, which said that knowing what an asset is worth is a prerequisite for intelligent investing. And by having said that, probably for making money as well and increase and grow your wealth. If you're interested to know more already from Damodaran, so he has this book which is called Damodaran Valuation, which is a book about security analysis for investment and corporate finance that you can find on Amazon. And it's really a great book, I must say. It's a very in-depth book about corporate finance and the analysis of securities in the sense of prior to an investment. So when we discuss valuation, I think it's important first to understand what does it mean to evaluate, why are we doing, and what does the act of valuation represent. So the act of valuation is trying to define and to determine a reasonable estimation of the worth of an asset. And the asset can be a company, can be a startup, can be a car, can be a manufacturing plant, can be an intangible asset like an intellectual property or patent. So the objective of valuation, there are mostly two purposes. You're going to have some people who evaluate for information purposes, so in the sense that they will provide that information for free, or they're going to provide that information for a certain cost, so they're going to monetize the act of valuation. And very often the objective of valuation is, after having received that information or having done the analysis, is to do a transaction, either from you are on the buyer side or you're on the seller side. So as said, I mean, a lot of people evaluate, can be investment bankers, can be private equity people, business angels, can be you as a private investor. So you have lots of people who use methods of valuation to try to estimate what a company is worth. And as already said, you on the buyer side, and the intention of the buyer is to buy as cheap as possible and avoid overpaying. While at the same time, when you're on the seller side, you try to sell as high as possible and avoid underselling the worth of the asset. So there's going to be always a tension between the buyer and the seller side. When you look at the categories of valuation, and the purpose of this video is not to go in depth, and I will share it at the end as well. If you really want to go in depth into company valuation, you can look at the Damodaran book. I have a specific training, which is a 7-hour training on company valuation, and actually this is a very small extract of that course. So the first method or category of valuation is what we call absolute valuation. And in that there are actually two sub-methods. The one is being asset-based valuation. And for those of you who know Warren Buffett, until only recently, let's say 1-2 decades maximum, he was always a very big fan of looking at the book value, so the equity value of a company, but he actually changed a little bit his mind and so went away from asset-based valuation into what we call a going concern valuation. And the accounting term of going concern means that and assumes that the company is stable and will remain in business forever, kind of. That's what we call an absolute going concern valuation. And what's changed, and also where Buffett changed his mind, looking at book value, equity value as, let's say, the holy grail of valuating companies, and I do agree with that. You buy a company, you buy an asset, not just for what the asset is worth today, but for the future streams of revenue, of income, of profit that the company will generate or that asset will generate. So, and here is where the going concern valuation kicks in, where indeed the going concern valuation methods, and I'm gonna share this with you in a couple of minutes, is those are the methods that take into account not just what the asset is worth today, but you try to guess, to estimate what those assets will generate in terms of future streams of revenue and profit. And this is where very often you're going to hear as an investor speaking about discounted cash flows or free cash flow to the firm valuations. In fact, most of the investors, specifically the traders, let's say the momentum investors that look at technical graphs, which is absolutely not my style. My style is being a value investor. So those people, they look into relative valuation, and relative valuation is really a way of comparing a company versus another company, or comparing an industry with another industry, or geography with another geography. So it's basically calculating ratios, and by calculating those ratios, it makes the comparison between two companies much easier. So I'm not saying that relative valuation is bad. It's one of the methods that I do use as well, but I use a combination of absolute valuation and relative valuation. I use a combination of asset-based absolute valuation, going concern absolute valuation, looking at the future streams of revenue, but also relative valuation. So if you want to, let's say, educate yourself further on who are the valuation experts, obviously, Benjamin Graham, I have the book here behind me with his very famous book, Security Analysis, but also The Intelligent Investor. He has been actually a little bit the founder of the thoughts and thought process around value investing. So he has actually documented in the very, very early 20th century how to evaluate assets, how to look into earnings and dividend payouts. Then obviously, the the Oracle of Omaha in Nebraska, that's Warren Buffett with his partner Charlie Munger. So they run Berkshire Hathaway. They're one of the most, let's say, largest companies in terms of market capitalization in the world. And as that initial position of Warren Buffett was to look at book value, so an absolute asset-based valuation. But after around the year 2000, in the shareholder letter, he actually turned a little bit away from the book value and said, no, you can not only look at book value. It's good to look at book value, but you also need to look at what are the future earnings that the company will generate. So basically, and it was discussed in one or the other of his annual shareholder meetings, and he received questions on that as well, how he was calculating the intrinsic value using discounted cash flow or free cash flow to the firm method. Then Peter Lynch, I do like Peter Lynch, so he had also a specific way of valuating companies and trying to understand if the market was giving an undervaluation or an underpricing of the company versus the real worth of the company. And then I already mentioned Aswad Damodaran, who is a lot focused on financial analysis, corporate finance, and specifically the valuation part of it, and he's considered a little bit the dean of valuation. So if I extract from my 7-hour training related to company valuation, and I'll start with absolute valuation, I'm just going to give you a hint, the first introduction into what are the different methods that exist in terms of absolute valuation. So first, the absolute asset-based valuation is you're looking at the current state of the company. And for that typically, and I'm going to show this to you in the next slide, you will look typically at the balance sheet. So remember that the balance sheet, which is one of the financial statements, actually captures the wealth of the company since its inception. So there we're going to look at, first of all, the market capitalization. We're going to look at the cash to market cap valuation, because sometimes the market is giving you the company very close just to the value of the cash and cash equivalent assets of the company. The book value, which is also the equity, let's say, analysis method, where you're going to look into all the assets, removing debt, and what remains is actually the book value of the company, the equity value of the company. I also in the training explain the adjusted asset method. You have some assets like buildings, like lands, that very often are undervalued in the balance sheet because the company has decided to take a more defensive stance or carries the land assets at cost. But if the land has been bought 30 years ago, I mean, obviously there has been inflation, and so you need to reevaluate, readjust that asset. It can also happen for brands, so those intangible assets. And again, I'm explaining this in the training. It's not the purpose of today. I'm just giving you an introduction today on the ways of potentially adjusting assets in a balance sheet of companies. Then we have the liquidation value method. That is a specific valuation method. If there would be a fire sales or the company would be really under stress, you can then also think, how does the valuation of the company change because there is an urgency to sell off all the assets. So that's the absolute asset-based valuations. You clearly see, and I will show it in the next slide, that this is strongly based on the balance sheet. Then when we are studying absolute valuation methods, we're looking at the going concern absolute valuation methods. There indeed, for some companies, specifically startups that are not writing profits, you're going to do a multiple revenue method, for example. You can also do multiple earnings when the company is making profits. And then the two let's say methods that are most used are the free cash flow to the firm and the free cash flow to equity, and have even a specific training, 1 hour training specifically on that, or you will also find all the necessary information in the Art of Company Valuation training. So that's for absolute valuation. What I like always to show is where do you find the information, because, and I've learned this also from Warren Buffett, and I do read a lot of financial reports, the 10K, 10Q, so the quarterly and annual reports of publicly listed companies. And in fact, all the information is available. I mean, if you want to do a book value appraisal of a company, I mean, you need, of course, to understand and to be able to read the balance sheet, but the information is there. But not a lot of people do the effort, put the effort on the table to do that. The same with adjusted asset methods. It's not necessarily rocket science for most of the companies. You can find a way how to readjust some assets like the brand value, for example, which is an intangible asset in the balance sheet. So most of the information specifically on absolute valuation, asset-based valuation, you're going to find in the balance sheet. Then obviously you're going to use some external sources to readjust things. For example, if you're readjusting the cost of land, you need to know how the cost of land has been evolving. Let's imagine in the Minnesota area, Minneapolis area, if the company has a manufacturing plant since the last 30 years, where the let's say the manufacturing plant was brought into the balance sheet, and also the land that was bought and is being an asset actually carried in the balance sheet. So obviously that land, the cost of that land, if the company would have to sell that asset, the cost has changed. When you look at and studying the absolute valuation methods, when you're looking at going concern, so there indeed you're going to use less the balance sheet, but you're going to use more the income statement and the cash flow statement. So it really depends if you're looking at earnings. I honestly prefer to look at cash flow statements, because you're going to capture a lot of things that sometimes, and you may have companies that try to cook the books from an accounting perspective and make them look better than they really are in the income statement. I prefer to look at the cash flow statement, but both methods are okay. So when we're going concern valuation, you could do a discounted future earnings method. You can do a discounted free cash flow to the firm. And then obviously looking at return to shareholders, you're going to look at dividend discount models. But also if the dividends are growing over time, you're going to use a golden growth model. And if the company is doing share buybacks, you may look at the total shareholder yield. And for that, you will need the cash flow statement, in fact. And as already introduced, I mean, we have the relative valuation, which is a different, let's say, philosophy. So you will not be directly able to determine the intrinsic value of the company, so what the company is really worth. But for that, as said, you use absolute valuation methods, and more specifically going concern valuations. And in the relative valuation, I kind of summarize it, it's like benchmarking. So you calculate ratios, you calculate the price to book ratio, the price to cash flow, price to earnings, price to sales, a lot of people look at the price to earnings, and even sometimes a lot of people put a lot of money into the stock market just because the price to earnings is low. That's not good enough, guys, seriously. And you have sometimes enterprise value to EBITDA, enterprise value to sales, price to earnings growth as well. So you have different ways of, let's say, calculating the relative valuation of a company. As said earlier, I do use relative valuation because it gives some interesting aspects, and sometimes I have 2 or 3 companies that I understand and that have similar, let's say, safety margins on the intrinsic value, and sometimes the relative valuation will give me something different on a price to book, on a price to earnings perspective. And as already said, it's not the purpose of this video to go in detail. If you're really interested in it, please go on my Udemy and Skillshare. You're going to find in the description of this video, you're going to find the link to my Udemy and Skillshare trainings. And there you will be able really to go deep into those valuation methods. Taking the same, let's say, logic to show where you find the information, when you look at price to book, you're going to first of all look at the balance sheet. When you look at price to cash flow, I mean, the name already states it, you're going to look at the cash flow statement. And when you look at price to sales, price to earnings, you're going to look at the income statement. So you see that actually the intention of evaluating a company requires a minimum of accounting understanding, being able to read financial statements, balance sheet, income statement, cash flow statements. So that's the kind of thing where a lot of people, and I mean, I speak here about valuation. I'm not a momentum investor. I do not look at technical graphs and try to predict from the graph what will happen next. I really try to make up my mind about and looking at financial statements of the company. So in order to do that, in order to be a serious value investor, you need to have a minimum of accounting understanding. It's not rocket science. It takes a couple of hours to understand the main things, but you will require this. And you see here and also in the absolute valuation table that we are using as source of information and source of valuation, the balance sheet, the income statement, and the cash flow statements. So all in all, wrapping up here. So always keep in mind when you look at valuation methods that there are different ways. There is not one or the other. It's really a combination. And me as a value investor, for my own money I put on the stock exchange, I use a combination of absolute asset-based valuation, absolute going concern valuation, but also relative valuation. And the combination of the 3 methods, and I'll try with that since more than 20 years, gives me a good feeling if the company, there is something going bad about the company or not. Always remember when we discuss about valuation, and this is also the reason why I call my course The Art of Company Valuation or The Art of Value Investing, because valuation and investing is an art. It requires human judgment, human creative skills. It's never perfect science. And the reason for that is that you're going to have valuation mistakes. I mean, if I take the example of the going concern absolute valuation, you will have to guess the future earnings and the future profits of the company. You don't have a crystal ball. You do not know if you're doing a free cash flow to the firm 30-year evaluation. You can only guess what will be the growth, what will be, let's say, the return that you're expecting as well, and potentially also how the revenue, not just the economy, but the revenue of that specific company in which markets will grow. So you're going to have some environmental or macroeconomical environment uncertainty. You're going to have always estimation uncertainties. It will never be a precise science. I mean, except if you're the owner of the company, you do not know what management and board of directors will decide next year. So if you're a minority shareholder, you will have difficulties to be able to predict this, specifically over the next 10, 20, 30 years. And always remember, please, that financial statements are per default inaccurate because they are an inaccurate representation of more complex processes, business processes of the company. So even the accountant sometimes has to make judgments and calls about how to book in on and how to fair value an asset or an operation. So keep that in mind. And also, and wrapping up on the valuation mistakes thing, and also the valuation methods, we are not speaking about financial analysis here. So financial analysis is really the process of trying to determine the performance of the company, where we're going to look at stability, solvency, liquidity, and also profitability. That's not the idea of company valuation. Company valuation and financial analysis are complementary. Company valuation will allow you to determine the worth, what an asset is worth. And then you're going to have, if you're on the buyer side, you're going to have a seller who will say, well, listen, I'm selling you this asset for 100. And you're going to say, sorry, I did the valuation. I believe the asset is worth 70, even with the future streams of earnings for the next 30 years. And then you will try to negotiate or potentially walk away if you don't find a ground for settlements. Last but not least, so I already mentioned it, and you're gonna have it in the description of the of this video. So you're gonna have the links to my Udemy and Skillshare education trainings. I have already a couple of trainings there with hundreds of students that are taking those trainings, where you will be able to go much deeper than the time I have to do on the Value Investor channel, and also be able to practice. Also, by subscribing to those trainings, you will be able to participate also to regular webinars. Just showing you an extract of the Art of Company Valuation training. So it's a 7-hour training. It's a pretty big training, but you see that we're gonna go through all those methods of valuation, also with some special valuation situations like merger and acquisitions, private equity, venture capital, IPOs and direct public offerings, and also banks, because banks, in order to evaluate or to determine the intrinsic value of a bank, you will use more book value than other valuation methods. So really, I mean, if you want to go into it, and as I always tend to say, I like to practice since more than 20 years. This is why I continuously read those financial reports, if they're annual, quarterly, etc. So in this training and in all my trainings, we're gonna play and read real financial statements. In the Art of Company Valuation training, where I'm showing you here the table of contents, we're going to practice with Microsoft, with Apple, with Richemont, which is a Swiss luxury brand, and also Kering, which is also, I think it's a French luxury brand. So we're going to look at those financial statements and do the evaluation and see what the outcome is. And we are doing this for all the methods for the 4 companies through the whole training. So I hope you enjoyed this video. If you want to know more, as already stated, about value investing, about company valuation, you can find in the description the link to my Udemy and Skillshare trainings. Thanks for tuning in, and I hope to see you very soon. Thank you.